The United States owes more than $39 trillion, a number so large that it becomes difficult to even visualize. And instead of collapsing under that debt, America continues borrowing even more. What makes this remarkable is that other countries have experienced major economic crises with far less debt. So why is America different? How did the United States build a system that allows it to keep borrowing on this scale? And what happens when debt becomes a foundation of the global economy? America's debt is closely tied to the US dollar. Because America is not just another country borrowing money, the dollar plays a central role in the global financial system. International trade heavily relies on the dollar. Central banks hold dollar reserves. Investors continue buying US Treasury bonds. In fact, the more uncertain the global economy becomes, the more investors often move money into American financial markets. That kind of trust doesn't happen by accident, but this system took decades to develop. You see, after World War II, America emerged from the conflict stronger than most countries. Its economy was the largest in the world. Industries across the country were powering global production. Its military power had no equal. And despite political tensions over the decades, investors around the world trust America's financial markets. That trust helped the dollar become the foundation of international trade and global reserves. That status gave the United States a unique advantage: the ability to borrow at a scale most countries would struggle to maintain. Because when America needs to borrow money, investors from around the world are ready to lend it. Normally, rising debt makes investors more cautious, but with the United States, the opposite often happens. The more unstable the world became, the more money flowed into American financial markets. When people hear America owes $39 trillion, many assume the country is operating like a business drowning in debt. But sovereign debt works differently. The US government mainly raises money through financial instruments known as Treasury securities, which includes Treasury bills, bonds, and notes. Investors lend money to America, and in return, the government promises to pay them back with interest over time. They're purchased by governments, banks, pension funds, organizations, and private investors all over the world because US Treasury securities are widely viewed as some of the safest financial assets in the world. And that perception matters a lot, especially during economic uncertainty. Ironically, the more unstable the global economy becomes, the more money often moves into US debt markets. Because during periods of uncertainty, investors tend to move capital toward assets they believe are safer and more stable. Even when America itself is deeply in debt, that is part of what makes this system so powerful. Japan alone holds roughly $1.2 trillion in US Treasury securities. China holds hundreds of billions of dollars as well. And collectively, foreign governments and international investors hold more than $9 trillion in American debt, which creates a defining reality. The global economy is deeply connected to America's financial stability. This is because the dollar system became integrated into global trade, banking, reserves, and investment flows. And once systems operate at that scale, they become extremely difficult to replace. Most countries cannot continue expanding debt without consequences, because once investors begin to lose confidence in the economy, money starts leaving the country, the currency weakens, and economic crises can escalate quickly. History has shown this repeatedly. For example, Argentina repeatedly faced debt and currency crises that drove inflation significantly high and caused many investors to lose confidence in the economy. Greece also faced a severe debt crisis that triggered years of economic hardship, high unemployment, and deep government spending cuts. For many countries, debt crises can trigger years of economic instability. But the United States is in a different position. The US government owes debt in dollars. In other words, it borrows in its own currency. and the dollar remains the dominant reserve currency in the world. That creates what some economists have called exorbitant privilege. Very few countries have that kind of flexibility. As a matter of fact, no other country enjoys this advantage on the same scale, and this is one reason America can continue running large deficits while still attracting money from around the world. Today, U.S. government debt has grown to more than $39 trillion, a figure larger than the economy of every other nation on Earth. As a result, U.S. government debt became so important to global finance that banks, governments, and investors around the world all became deeply tied to it, which meant trust in the American financial system became a concern for the entire global economy. America's borrowing power expanded even further after the 2008 financial crisis. The crisis began after years of risky mortgage lending and a housing bubble that eventually collapsed. When the housing prices collapsed, major financial institutions suddenly faced severe losses. The trust that held everything together began to crack. As losses spread, banks became reluctant to lend, investors grew nervous, and credit became harder to access. For a moment, it felt like the entire global economy was under pressure. However, to prevent the crisis from spreading further, the Federal Reserve cut interest rates to near zero. The goal was to make borrowing cheaper and encourage economic activity. The Federal Reserve also injected trillions of dollars into the economy by lending to financial institutions and purchasing large amounts of U.S. Treasury bonds and other financial assets. The aim was to keep banks functioning and keep money flowing through the economy. Years later, another shock arrived: COVID-19.
In the past 2 weeks, the number of cases of COVID-19 has increased 13-fold.
As countries entered lockdown, businesses closed, flights were grounded, and economic activities around the world came to a halt. Once again, the U.S. government approved trillions of dollars in economic relief.
In American history, and I must say, or any other package, by the way, it's twice as large as any relief ever signed. It's $2.2 billion, but it actually goes up to $6.2 potentially trillion dollars. So you're talking about a $6.2 trillion bill, nothing like that. And this will deliver urgently needed relief to our nation's families, workers, and businesses.
While the Federal Reserve injected trillions more through bond purchases and emergency lending. The result was one of the largest economic intervention efforts the world had ever seen. Critics warned this level of money creation could eventually weaken confidence in the dollar. Yet despite repeated predictions of collapse, investors around the world continued buying U.S. debt. In fact, during periods of global crisis, demand for dollars and U.S. Treasury bonds often increased. Because, as we mentioned earlier, during periods of uncertainty, many investors still view the dollar and U.S. government debt as safer places to store money. In other words, the country carrying the most debt remains one of the places investors trust most with their capital. The impact goes far beyond the United States. Over the decades, the dollar became so important that its influence started spreading all across the world. It influences how countries trade, how businesses operate, and how money moves across borders every day. This is why when the Federal Reserve raises interest rates on borrowing in the United States, the whole world feels it. Borrowing becomes more expensive across parts of the global economy. Governments feel the pressure, and financial markets around the world react accordingly. That's how much influence the dollar still has. And this is why the rest of the world pays close attention to America's debt situation. Not simply because of the volume of the debt, but because the global economy is heavily tied to it, which means a decision made by the Federal Reserve can ripple through economies around the world. But this raises an obvious question. Who ultimately pays for the $39 trillion debt? The debt still has to be repaid. but not in the way many people imagine. The United States does not suddenly receive a bill for $39 trillion all at once. Instead, when existing debt comes due, the government typically borrows again to repay it, while continuing to pay interest along the way. In other words, it functions more like an ongoing cycle than a single loan that eventually has to be fully paid off. Part of the money needed to service the debt comes from taxes. The U.S. government collects tax revenue every year, and a significant portion of that money now goes toward paying interest on the debt, not necessarily paying off the entire debt itself, but paying the interest owed on it. And as the debt grows, those interest payments grow too. But there is another layer to this. Sometimes large debt burdens become easier to manage over time through economic growth and inflation. Because as the economy expands, incomes rise, businesses grow, and governments collect more tax revenue. As a result, existing debt can become easier to manage compared to the size of the economy. But inflation also comes with consequences. If prices rise too quickly, ordinary people can lose purchasing power. Everyday living becomes more expensive and less affordable. Some of the effects can eventually be felt through higher prices. And this is part of what makes America's debt system so unique. The debt keeps growing, yet the system continues functioning. Because investors still believe the United States will meet its obligations. And for now, the dollar continues to play a central role in the global economy. None of this happened overnight. It developed gradually over decades. As the dollar became deeply embedded in the global economy, America's debt stopped being only an American issue. Today, decisions made in Washington can affect economies far beyond America's borders. None of this eliminates the risks associated with rising debt, but it helps explain why the United States can continue borrowing on a scale that would be difficult for many other countries to sustain. Because behind the $39 trillion debt figure lies a system the world still depends on. And the question is no longer whether America can keep borrowing. It's what happens if the trust that supports that system begins to weaken.